Shifting to another area of the economy, productivity. The OECD recently published a report revealing that productivity growth remains below pre-financial crisis rates in many nations, including the US, UK, and Germany. But labor productivity apparently began to decline well before the financial crisis. For Insight, we are joined by Eran Peleg of Clarity Capital. Thank you very much for being with us.
Pleasure to be here.
Well, look, productivity is a central driver of economic growth, and yet in many advanced nations, we're seeing labor productivity decline. Explain that.
So, no one knows the exact answer, obviously. There's a number of possible explanations that one can put forward. The explanations range between one being that economies have moved more from being a manufacturing-oriented economies to services-oriented economies, services sectors where often workers are less efficient. Often it's more difficult to automate jobs in those sectors. And frankly, also it's much more difficult to measure productivity in the services sector. But that's one big reason. And this is a shift that we've seen across many, many countries from manufacturing to services. Second, there might be a possibility that we're seeing some kind of mismatch between the skills of the workers and what is really needed with modern businesses. So, Western education systems are, turning out graduates that might have the right skills that businesses really need. This raises all kinds of interesting questions about, maybe we should change the education system, whether perhaps we need more on-the-job training. But that's another possible explanation. Another explanation is that, although we've seen a lot of advancement in technology, actually, especially since 2008 in the big financial crisis, there's been a slowing in technology investment in many economies. So we have better technology, but businesses are investing less in technology now than maybe previously. And another one is that business formation is really slowed as well. Often or usually, new businesses are more efficient than older ones. And as formation of new businesses slows, that has an impact on productivity at the overall macro level.
Well, last month the OECD released its Compendium of Productivity Indicators 2016 report. What were the main highlights from that report for you?
So the main highlights, first of all, they established the fact that we are seeing a slowdown in productivity growth, and this goes back to 30, 40 years back, but is also clear is a clear trend in the last 10, 20 years as well. We're seeing across developed economies, maybe 10, 20 years ago, we've seen productivity growth at around, say, 2-3% level on average across economies. More recently, in the last couple of years, it's more around 1%. The big issue with that, obviously, is that, as you say, productivity is a big source of economic growth. And, either you put more workers to work, you have a growing workforce that produces more, or you get your workers to produce more per 1 hour worked. So, in a world where workforces are pretty much stagnating, because of general population trends, demographic trends, the importance of productivity just becomes more important, and this slowdown really means the best we can hope for is 1% productivity growth and very little growth in the workforce. That growth going forward might be very, very low.
Well, thank you very much, and indeed, an irony. We do appreciate your insight.